right, everybody, we're going to go over what happened during the week of July 25th, not just in the currency market, but in the financial world altogether, including economic news. So it was reported, let's get right to it, it was reported that world debt has exceeded $300 trillion. That's up from the roughly $200 trillion right before the financial crisis of 2008. So obviously, consumers, banks, businesses, and governments haven't learned their lessons. So be aware of that. It's up to over 300 trillion from the 200 trillion mark. Not a whole lot of news prior to Wednesday, which was the Fed interest rate decision, and then Friday morning if you're in Asia, or Thursday evening if you're on the East Coast of the United States, was when the Bank of Japan announced their interest rate decision. But there were some things that we could discuss real quickly prior to Wednesday. Dallas Fed, they came out, they said outlook contracts for the 19th straight month with wages crashing to September 2013 lows. They said large customers are dragging out their payments, causing cash flow problems. Global economies and the U.S. economy are very weak and uncertain, the Dallas Fed said. So that wasn't too good a news there from the Dallas Fed at all. Let's see, what else did we have for the week? Some very conflicting housing data came out. So Case-Shiller came out, which is the go-to index of, I think it's the top 20 markets in the United States. That missed estimates. It dropped the most in 2 years. And the estimate it missed was a lowered estimate by analysts. So that's not good. That was on Tuesday. Also, PMI services came out. We're going to touch base again more on housing as the week goes on. Also Tuesday, PMI services missed a lowered estimates, tumbling to 5-month lows. And the yield curve on the 2 and 20 became the flattest since the financial crisis, so not good there. Then all of a sudden, later on Tuesday, consumer confidence came out with better than expected numbers. New home sales came out 32,000 units higher, which was unexpected. New home sales rebounded the highest since 2008. That doesn't make a lot of sense at all when you have the Case-Shiller coming out, and then as I'll announce some other housing data that was released during the week, you're going to see that new home sales, it was either an anomaly or a miscalculation by the National Association of Realtors and or the government. This was big news, which was on Wednesday prior to the FOMC releasing their interest rate decision. Listen to this. Pending home sales came in at 0.2%, and estimates were supposed to be a 1.2%, and those estimates were lowered by analysts. That is a huge miss for pending home sales. Now that's existing and new. Okay, so the new home sales doesn't make sense. It doesn't coincide with the Case-Shiller index at all. Also, before the Fed announced rates, was durable good orders missing estimates and crashed the most in 2 years. In fact, it's the longest non-recessionary streak of declines in the U.S. history. Now, go figure that, right? So the government is trying to tell us that we are not in a recession. We've been saying we are in a recession for quite some time now. The government's trying to tell us we're not, but yet all these bad numbers are coming out, and durable goods, I mean, that to me, that just puts the nail in the coffin. It's the biggest crash in 2 years, longest non-recession streak of declines in U.S. history. Well, why? Because the government keeps saying we're not in a recession. So that's just a complete joke at all. Then the FOMC comes out. They say they leave rates unchanged. They say near-term risks to outlook have diminished. They said labor market strengthened. The job gains in June were very strong. The economy expanding at a moderate pace, and households are strong. That is a complete farce. I mean, what they're doing is what they're announcing is an absolute joke. Now, let's go past that Wednesday, the Fed announcement, and we move into Thursday, the Atlanta Fed, they slashed their second quarter GDP model number down to 1.8% from 2.4%. That's a cycle low for the second quarter. Now, on top of that, Greenspan comes out he was on Bloomberg, I believe it was, and he's talking about how there's so much economic uncertainty around the world and in the United States. Now, this is all after the Fed just told us that the economy, jobs are strong, households are strong, the economy's growing at a moderate pace. Ford, okay, and again, now I just want to touch base about Ford because it is Ford, one of the largest auto manufacturers in the world. They came out with horrible earnings, and they said they don't see growth. They are warning that the U.S. auto industry has plateaued. Absolutely horrible. If things are so good, households are so strong, and the economy is growing at a moderate pace, Ford would not be saying that. It's not a company issue. It's an industry issue. On top of all this, to refute what the Fed is telling us, home ownership is the lowest since 1965. What's that? 35, 40. It's 50 years. The lowest level of home ownership in 50 years. Again, if households were so strong and the economy was growing moderately at a decent pace and jobs were strong, people would be buying homes. Banks would be lending. And all of that is coming out to be completely false. Let's move on into Thursday evening on the East Coast of the United States, or Friday morning if you're in Asia. Bank of Japan, they announced their interest rates unchanged. As a matter of fact, the only stimulus they increased was going from 3.3 trillion to 6 trillion yen in their ETF buying. What else did they do here? Maintained monetary policy program at $80 trillion. Oh, they doubled the U.S. lending program to $24 trillion. Okay, so the buying ETFs and buying paper in the United States is the only thing they increased as far as their stimulus program. They didn't. Now, Ben Bernanke flew over there and met with the Bank of Japan, met with Kuroda, met with Abe the week of, I believe, July 4th. And from everything we've read and people that were in that meeting, they were saying that helicopter money was discussed. Now, what's helicopter money? Helicopter money is the government actually giving money to the people, whether it's through a form of a tax rebate or a direct check, however have you. That's what helicopter money is. They did, and the world was expecting Kuroda and the Bank of Japan to increase their stimulus program and possibly do helicopter money. Well, they did neither. As a matter of fact, Kuroda is instructing his cabinet or his people that work for him to come and do a report on the effectiveness of zero-bound rates, negative rates, and QE, a matter of fact. So to me, it sounds like this is the first central banker that is actually thinking, well, maybe QE, maybe zero-bound rates, maybe negative interest rates don't work. Don't do what the theory told us it was going to do. And we've been saying that now for several years. As a matter of fact, we did a podcast last week on why the Fed needs to start raising interest rates now, start normalizing rates now. And we even did a blog post on it. Hopefully you read it, or hopefully you heard the podcast. It's the complete opposite thinking of what central bankers are telling us and what mainstream analysts are telling us. Now, let's go a step further. We're going to Friday. The United States announces their GDP for the second quarter. Remember, I told you Atlanta Fed lowered their model. GDP came out at 1.2%, far below the estimate. As a matter of fact, they even lowered the Q1 GDP reading down to 0.8%. So the Fed is so far behind the curve, and they've painted themselves in a corner. They don't want to admit that zero bound rates, QE, we don't have negative rates here in America, but almost zero-bound rates, and QE didn't do what they thought it was going to do, not creating jobs, not creating inflation, not creating strong economic growth. They won't admit it. Therefore, they're trying to tell us that they're remaining hawkish, where they want to raise rates going forward because things are getting so strong, because the economy is growing, because it's creating jobs. And it's absolutely complete opposite. They need to raise rates because of those reasons we've outlined in our blog and our podcast last week. They don't need to raise rates because the economy is strong. They need to raise rates because the economy is stuck in mud and can't get going. Conventional thinking is you got to continue to lower rates for the economy to grow. Yes, but there becomes a point where when interest rates become too low, that it does not create jobs, does not create economic growth. And again, we've outlined that. And we've been saying this now for quite some time, and you know what? The more time goes on, the more the Fed and central bankers continue to go down this path of QE and low interest rates, the more we're being proven correct. What else came out? Oh, Friday, it was announced by Bank of America, HSBC, and Credit Suisse that their clients have never been so bearish. And I'm not talking retail people. I'm talking their institutional clientele. So that's not good. And just some other points I wanted to bring up before we end the podcast. In the United States, including Social Security, there's over 160 million people, including Social Security. There's over 160 million people in the United States receiving a check from the United States government costing the United States government over $3 trillion a year. In fact, those are called entitlements, okay? That entitlement economy, if you want to call it an economy, is the sixth largest economy in the world. Can you believe that? Just think about that. The entitlement program to over 160 million people in the United States is the sixth largest economy in the world. That is mind-boggling. And if you don't realize that the United States has an entitlement program because of what these politicians are doing, you need to wake up. We need to make a radical change in who's leading our country. And I'm not just talking about from the presidency. I'm talking all the way down to your local politician. A couple of quick things. Barack Obama will be the only president in the United States history to never have 1 year of 3% economic growth. That's staggering. He also is the only he also added more debt than every president combined in the United States. In fact, our national debt is now over $19 trillion and grows at $1.6 billion every day. Now, put that in perspective, the Treasury has to print approximately $50 billion per month, and they do that via the Treasury auction, which is increasing the money supply and impacting everybody's standard of living in America. If that doesn't get your goat, I don't know what will. Anyway, so I hope you share this podcast. I hope you get it out to your buddies. I hope they start to wake up and realize what's going on in the economy, why they're struggling, because most people are struggling, either not working or working low-paying jobs and living paycheck to paycheck. Let's face it. And if the government keeps printing $50 billion a month, $50 billion, let me just make that clear, $50 billion a month, they're continuing to devalue our currency. That's why it's harder and harder to get by every month. And that's why it's a lot harder to get by just a matter of 10, 15 years ago. Anyway, so I'm going to wrap it up. Have a great day. Thank you for listening.